Private equity means investing in private companies rather than in public companies which are traded on a stock market. Over the years, private equity has grown dramatically, allowing institutions and wealthy individuals to generate better long-term returns.
Over recent decades, that has turned into a major investment sector with huge amounts of money coming into it from the world's largest institutional investors and sovereign wealth funds.
You may not realise it, but private equity have backed companies who have grown to become major household names. Companies whose products and services you may use yourself. Private equity investment companies allow you to access this exciting asset class simply. You buy the shares in the investment company through the stock market, which then invests in a wide range of private equity investments to spread risk.
Through investing across a portfolio of companies, the average private equity firm will invest across 10 to 15 companies. It's possible to spread that risk and get appropriate diversification.
Some investment companies make direct investments in private businesses. Others take a fund of funds approach. This means that they invest in a range of other private equity funds, each with their own portfolios, to provide even more diversification.
An investor in a fund of funds such as ours benefits from the fact that we have a very large investment team. What we do on behalf of investors is look to select the leading 12 to 15 managers and to get an appropriate portfolio diversified by sector, geography and size.
And really the model there is to provide an investor who may not have any private equity exposure with a ready-made portfolio or ready-made programme, which would be very difficult to replicate without an extremely large pool of capital.
This portfolio is managed very differently to a portfolio of stock market shares, as the private equity manager gets involved in the day-to-day running of the company.
The private equity owner sits on the board of the company. They have the ability to change management. They review the budgets. They review on a monthly, if not daily basis, progress against those budgets, and therefore are much more involved in the day-to-day management of these companies, and generally speaking, bring a skill set to that the underlying company managers may not even have.
So why should you consider a private equity investment company? Well, private equity investment companies tend to perform better over the long term than stock markets. Over 1, 3, 5 and 10 years, the average private equity investment company has delivered better returns than the FTSE All-Share.
Today, value creation has to come through operational improvement, strategic improvement, international expansion, buy and build strategies, all of those more active approaches that actually are now critical to achieving the kind of returns that private equity aims to deliver.
As an industry, we have created an astonishing amount of jobs, and we've nurtured companies to grow them and make them better, rather than reducing costs in order to generate returns. So it's value creation in a much more proactive and positive way.
However, with the prospect of higher returns comes greater risks. Private equity investment companies tend to do well in strong economic conditions, but can suffer in difficult times like the financial crisis, which is why you should be prepared to hold your investments for the long term, at least 5 years, preferably longer.
There are two types of risk in the business, the operational risks and the market risks. We are quite experienced in managing the operational risks, which are to do with the management of the company, the operation of the business, how money is deployed. The market risks are not possible to mitigate, and the key skill for us is to try and find businesses in markets which will display the growth necessary to allow them to prosper.
Private equity investment companies are not suitable for you if you need a guaranteed return or cannot afford to lose money. The costs of managing the portfolios also tend to be higher than other funds due to the amount of work involved in selecting and managing suitable investments.
The risks in private equity are managed quite simply by spending a lot of time before you commit yourself to an investment. So a huge amount of upfront work is done in the so-called due diligence phase, building up as much knowledge as is humanly possible to have before you make the investment.
If you aren't sure about whether private equity investment companies are right for you, you should speak to a financial advisor. But if you can accept the risks, they can add something different to a long-term portfolio. Investing in businesses where professional managers are involved hands-on right from the start.
You have to spend time getting to know them, then you have to spend time convincing them to sell their company to you, then you have to find the new management team to come in and manage it for you. It's full contact full-time.